in terms of this afternoon's, this session's agenda, we are going to work through, first, we are going to work through the background of the second comprehensive review of IFRS for SME accounting standard, including why the board is undertaking the review and what's the scope of the review and what kind of framework or approach the board established to develop its proposals. And secondly, we are going to introduce those main proposals in the exposure draft. We are also touching on some other topics which the ISB is seeking feedback on. For example, the board decided not to align the Section 20 leases of the IFRS for SME accounting standards with IFRS 16, but we still would like to seek the views from you on this topic. So in terms of background, first thing we would like to, I think from my point of view, and you also would like to ask is that why the board would like to undertake the second comprehensive review of IFRS for SME accounting standard. But before I answer this question, actually I would like to briefly introduce the short history of this standard. IFRS accounting standard is designed for the capital market. And in 2009, the board developed this IFRS for SME accounting standard. And this standard is simplified standard. It is specifically designed for those entities without public accountability. But those entities still needed to prepare general purpose financial statements in order to meet the needs of their external users. So after the standard was issued, starting from, I think, 2 or 3 years after that, the board started the first comprehensive review of these standards. And that review was completed in 2015. As a result, the board actually made very limited amendment to the standard. So that means because the standard is based on 4 IFRS accounting standards, but even at that time, actually the board has already issued several new IFRS standards, such as IFRS 10, 11, or IFRS 13. But the board decided not to incorporate those standards into the IFRS for SME accounting standard because of lack of implementation experience at that time. And soon after that, the board also issued a number of other accounting standards. For example, IFRS 9, IFRS 15, IFRS 16, also new conceptual framework for financial reporting. So with that, it seems a lot of things happening in terms of 4 IFRS accounting standards. And IFRS for SME accounting standard is based on 4 IFRS accounting standards. So the board decided that in, I think, earlier 2019, we decided to start the second comprehensive review of IFRS for IFRS for SME accounting standard. So because of a lot of things happen in terms of 4 IFRS accounting standard, the board decided that the objective of the second comprehensive review of IFRS for SME accounting standard should be focusing on updated IFRS for SME accounting standard to reflect those improvements that have been made in 4 IFRS accounting standards. Obviously, we still need to consider to make sure that these standards, still keep as simple as possible. So this is the main objective the board decided. But once we decided that objective, how to achieve that objective, so the first thing came out that actually the first thing the board decided or discussed is that what kind of approach we should take to achieve that objective. So in terms of the approach, the board agreed. First step of this review is to decide and to develop the request for information. And that request for information was issued in January 2022 to seek the views from stakeholders, whether and how we should make amendment to the IFRS 4 SME accounting standard. And the second aspect of the review, second aspect of the approach is that how can we approach, how can we approach the review, how can we develop the proposal which should be included in the IFRS 4 SME accounting standard. The board decided a framework which we called alignment principles. And then we used that principle, to decide whether, how, and when we should incorporate those requirements included in the full IFRS accounting standard into IFRS 4 SME accounting standard. And finally, considering the feedback we received on the request for information, we also particularly considered recommendation made by the ISB's SME implementation group members, and also applying the approach we agreed. The board proposed those improvements to the IFRS 4 SME accounting standard, which were included in the exposure draft. So in order to achieve, as I said, achieve that the objective we agreed and the approach we decided, and the first question immediately coming out that because the review is based on the full IFRS accounting standards. So which or how many full new IFRS accounting standards or the amendment to full IFRS accounting standards should be included in the scope of the second comprehensive review of the IFRS 4 SME accounting standard. So the board decided that in terms of the scope of the review, we should include the requirement in the full IFRS accounting standards issued since the first review of IFRS 4 SME accounting standard. That means it will include, for example, IFRS 9, IFRS 15, IFRS 16, new conceptual framework, etc. The board also decided we also should include those requirements in full IFRS accounting standards that were issued before the first review, but did not result in the amendment to the IFRS 4 SME accounting standard, which I previously mentioned, for example, IFRS 10, 11, or 13, etc. And in the meantime, the board also decided we also should include other topics that have already brought to the ISB's attention that relating to this standard. So this is the first question we facing, and we decided the scope of the review. And the second question, in order to apply that approach, we already decided is that what I mentioned, the framework we developed in order to decide and to propose the amendment to IFRS 4 SME accounting standard. So the framework we established, we developed for the second comprehensive review of IFRS 4 SME accounting standard is really about the three alignment principles. Because if we look at the objective we decided, there are two objectives. One is update the standard. Second, we still need to think about keep the standard as simple as possible. So based on that objective, we decided the three alignment principles. One is that first to look at whether if the board decide to make changes to the standards, whether that change to standard can make a differences to the decision made by the users of the SME's financial statement. If it's relevant, then we will move down to the next principle, that is simplification principle, and to make sure that appropriate simplification could be made. If the issues or the topic or the changes we are going to make to the standard is not relevant, then we will stop to go through the next two principles. And even there are any simplification have already made, the board also needed to go through the third principle, that is make sure that the resulting information are really faithfully represent the substance of the economics That is the third principle, faithful representation. And actually, during the request for information phase, actually we also received some feedback from stakeholders. And those stakeholders asked us, to do some kind of analysis in terms of cost benefit when we introduce new changes. So actually, if you look at the board decision and the papers behind it, actually when the board introduced all new proposals, we also conducted analysis of cost and benefit before the board made final decisions. So this is also one aspect. We address the concerns raised by stakeholders to make sure that cost-benefit balance is right.
So in the next session, we will be working through the snapshot that is on your tables in front of you. So you'll notice the slides are pretty much aligned with the snapshot. And we'll try and give you an overview of how we applied those principles in assisting the board to develop the proposals that are in the exposure draft. And we will try and focus on things that we're not doing, or simplifications the board made, so you can get an overview. So I think that's right, concepts and principles. So we'll start with the concepts and principles. As Jing Chao introduced the standard was, the first edition was 2009. It was based on the old conceptual framework for financial reporting, which the board updated in 2018. So the question we had when we were developing the request for information was, if we're aligning with IFRS and we're applying the principles of alignment, then, should we be aligning the framework? And we went out in the request for information and we sought views, and generally there was strong support for aligning the framework. So what the exposure draft is doing is setting out completely new section 2. You'll see if you look at the exposure draft, it's not marked up. It's a completely new section 2. I think that's important because if you update the standards, you need the updated framework that goes with those standards. But in doing that, that was a couple of things that we had to think about. One was the status of the conceptual framework. We got a bit of feedback in the request for information about the status because it's section 2 of the standard, so it has the status of a standard. In full IFRS, the framework doesn't have the same status as a standard. So what we've done is propose a new paragraph to be put in section 2 that says the requirements in section 2 don't overrule anything else that's in the standard. And that's important because the new conceptual framework updated some of the definitions of assets and liabilities. It updated some of the recognition criteria, along with clarifying some of the concepts. So what we had to do, just as they had done when the 2018 framework was developed, was we needed to go through the standard and see if we had any potential differences, any inconsistencies. And we basically took the same approach that was taken with the 2018 conceptual framework. So in instances, so section 18, which is intangible assets, and section 21, which is provisions and liabilities, we've kept the old definition of an asset and a liability. That's consistent with full IFRS. We decided not to update the word reliability with faithful representation for exactly the same reason that the board did with full IFRS, because it would be very tricky to look at each of the instances when reliability is used and see if it was being used differently from faithful representation. So to avoid any inconsistencies, we've taken the same approach. And also you'll notice in section 17 and 18 that we needed to remove the recognition criteria because that had changed from what was in previously. So one of the things we've done in this snapshot is try to say what will the effect of our proposals be on the SMEs and what will they be on the users of their financial statements. So we think that for SMEs, having the new section 2 will help them if they are instances where they've got to develop their own accounting policies, and we think that will be clearer. One of the things that the board decided to do was to retain the concept of undue cost or effort. So this is a concept that's in the SME standard, but it's not in full IFRS standards. And it gives the board opportunity at certain instances where it's looking for simplifications to use an undue cost or effort. And later on we'll talk about business combinations where the board has used that concept to simplify the requirements. And we hope the proposals will enhance the information that users of financial statements get. Now, what we've done on the slides is we've outlined the question that is in the invitation to comment. So you'll see that this, in the invitation to comment, we're not really asking, do you think we should align? Because we had that information from the RFI, we had general support. So we're actually saying, do you think we've got this about right? And what we're also just bringing to people's attention is that we're bringing back that old asset and liability definition, and we're asking your feedback on that, that requirement. Okay, so moving on to business combinations. If it's okay, we'll run through the main proposals and then we'll take questions at the end of this section, if that's okay with everyone. So the next big section is the business combination section, and this is section 19. The standard, the exposure draft is in a marked up form, but we are planning to put a clean version of section 19 on our website because it is quite heavily marked up. So what we did when we developed the exposure draft was we said things like section 2 and section 23, which are completely new sections, the section 12, which is fair value, we've not marked them up. All the other sections are marked up so you can see the changes, but section 19 has quite a lot of changes, and we do think it will help you if we put a clean version on. As Jing Chao said, this IFRS 3 was considered in the first review, but the board decided not to align at that time. We came back in the request for information. In the request for information, we took a slightly different approach than we had taken in the first review. In the request for information, we said, well, what are your views if we aligned certain parts of the acquisition method, but not other parts? So where the board has landed is taking into consideration the feedback from the post-implementation review and the outcome of that review being improvements to the definition of a business. The board felt quite strongly that given they'd had feedback in the post-implementation review, there needed to be some clarity and some guidance around that definition. We should make that guidance and clarity available to SMEs. So that's one of the first proposals, and that's led to a new appendix being added to the standard. In introducing the acquisition method, the board has actually made a number of decisions that are based on simplicity. So for relevance, it wasn't really a problem because the board already had the business combinations. What it needed to do was look at the improvements that the IFRS 3 2008 had introduced and look at the relevance of those. And what the board decided was it wouldn't update the criteria for the recognition of intangible assets or the clarifications around an assembled workforce. It wouldn't provide requirements for reacquired rights, and it would remove the option for measuring non-controlling interests at fair value. And part of the reason the board was able to make that decision for simplicity was because the IFRS for SME standard, unlike full IFRS standards, actually requires goodwill to be amortized. So the boundary between what's an intangible asset and what's included in goodwill is less significant in the IFRS for SME standard because we're going to have this annual amortization charge. So as a consequence, we were able to simplify while still obtaining faithful representation. There are a few other changes that we've made along with the acquisition method. We have, based on the feedback that we got to the RFI, where people were suggesting there needed to be more guidance when an entity was acquired by forming a new entity, we've added the guidance that we were asked to add. We have also decided, given that we were updating section 2, we would jump ahead a little bit because, as Jing Chao said, we had a cut-off of sort of 2018 for amendments, but we actually went to the board and we asked the board if we could bring in the May 2020 amendment, which aligns the definitions of assets and liabilities. So we brought in that amendment, so that actually, I think, makes things much simpler for SMEs in that they will apply the definitions that are in section 2. Contingent consideration was an area where IFRS 3 brought in the concept of measuring contingent consideration at fair value. We were concerned about introducing more fair value, and we sought views in the request for information on using the undue cost or effort exemption. And what the ED is proposing is measure at fair value unless there's undue cost or effort, and in which case you can put in at the most likely amount. You can measure at the most likely amount. One area that we sought views on in the RFI, and we've had a bit of mixed views, mixed between the feedback we got on the request for information and feedback that we got from our specialist consultative group, the SMEs, in that was around step acquisitions. What we have done is include proposals in the exposure draft for step acquisitions, and we'll be asking, there is a question on that in the request for information. And finally, aligning with IFRS 3, we've said acquisition costs are not part of that transaction, and so they would go to profit and loss. So what do we think this will mean for SMEs? We think bringing in that definition will be much clearer and simple to apply. It has expanded the length of the standard a little bit. We think step acquisitions, although we're asking a question, as you can see here, we think actually it would avoid time and discussions in that the standard would have the requirements, so an SME would know what to do in that circumstance. And then to users, we think there would be improved consistency and reduced diversity around how those acquisitions are accounted for, and a bit of enhanced information as well. So we think overall that the proposals are a balanced package. And as I said, we're seeking views on the step acquisitions because of the mixed views that we got. And one area where we are also seeking views was the non-controlling interest. And there was a bit of mixed reviews on this in the RFI as well. Because generally what the board has said in the past when it's developing the SME standard is if full IFRS has an option, it will take the simpler option into the SME standard. That's what we proposed, that's what we discussed in the RFI. We got a bit of mixed feedback. Some people felt that it was unfair to take that option away. So we're just asking for views on those proposals. Okay, so I'm going to move on to financial instruments. So this was, I think IFRS 9 is the standard that we've looked at and have taken bits and not taken other bits. So I will try and explain what we've taken and what we haven't taken in the next couple of minutes. Easton's laughing to see if I can do this. So the first thing is the financial instruments sections, which were previously sections in 11 and 12, have been combined to make room for the new fair value section. But those sections were different from any other section in the SME standard in that they had in them an option to fall back to IFRS standards, in that you could fall back to IAS 39. Now, the board had originally developed that because the financial instruments project was ongoing. The IFRS 9 is out. It's currently in its post-implementation phase. So the board were like, do we still need this option? We did ask in the RFI about keeping the option. There was no real strong evidence that we should keep the option, and it appeared only to be being used by subsidiaries that were applying the SME standard. So the board is first of all proposing to take away that option. Then, so having decided that, we then looked at the individual subjects within IFRS 9, and we started with classification and measurement. Currently, the SME standard has a number of examples, and you categorize your financial instrument pretty much based on those examples. What we got was some feedback in developing the request for views, the request for information, that actually sometimes it was a bit tricky because your financial instrument didn't automatically fit into some of those examples. So what we've done there is just add in a supplementary principle to say, if these examples don't work, you can use this supplementary principle. And that supplementary principle is based on the classification principle in IFRS 9 around contractual cash flows. But again, we've even simplified that because we've taken away the business model discussion, and we've also taken away the option to measure through OCI. Then the board had quite a long discussion about what to do about impairment, because in the request for information we said, okay, maybe what we should do for SMEs is take the simplified model that's in IFRS 9 and use that for SMEs. But even based upon that, we got some feedback that said this could be quite expensive for the SMEs to implement with not a major change in their trade receivables provisions. Based upon that feedback, we consulted with our SME group, and we also did some outreach with our global preparers groups to talk to the global preparers that were not financial institutions, because clearly the scope of the SME standard means that there aren't financial institutions in there. So based upon that, we came up with a number of proposals, and the board was concerned that we should get an outcome in the SME standard that wouldn't be substantially different from an outcome in IFRS standards. So whilst we, as staff, proposed maybe we could use a best estimate, the board said no, we don't like that, because they could say their best estimate is nil. IFRS 9 would not normally give you a nil answer for your expected credit losses. So then we looked at, well, maybe actually for trade receivables and contractual assets, we should stay with an incurred loss model, which we think is the bulk of receivables that most SMEs will have, and then we'll have a simplified expected credit loss model for other financial assets. Now, there's pros and cons to that approach, because, okay, that seems like a good approach, but then people have said, well, maybe you're adding a bit of complexity into the standard, because now you've got two methods of impairment. Ultimately, the board decided to make this proposal and hear from people about what it was proposing, and we felt by including that proposal, including both models in the exposure draft, people had the ability to comment. If we just included one, it would have been a bit more tricky for people. This way, we're giving everyone the information they need to comment. Then the next thing we needed to do was we needed to look at issued financial guarantee contracts. Now, the reason we needed to look at issued guarantee contracts was because the SME implementation group had issued a question and answer, a Q&A, on how to account for issued financial guarantee contracts. Now, the only thing the SME implementation group could do based upon the requirements, because they can only issue guidance that's based upon the requirements in the standard, was to require them to be measured at fair value. But in doing that, the SMIG had said to the board, we think in the next review you should look at this. So we did. The RFI proposed, or the RFI discussed, using the definition from IFRS 9 and the requirements of IFRS 9. Generally, people supported bringing in the definition of from IFRS 9, but they didn't really support the requirements. They felt the requirements were a little bit complex. So what the exposure draft does is it proposes a simplified measurement. It's still based upon IFRS 9, but its subsequent measure would be, so initial measurement, sorry, would be at premiums received and receivable at inception, and then subsequent measurement would be the higher of either your expected credit losses or the initial amount being amortized on a straight line basis. So in summary, the proposals in the exposure draft are just to add a supplementary principle to help with the classification, to add expected credit loss for financial assets other than trade receivables and contracted assets to address the accounting for issued financial guarantee contracts and to remove the fallback option. So we've taken just bits of IFRS 9. We had a lot of discussions with the board and a lot of support and help from our implementation group. We do believe that in terms for the SMEs, we think, as I said, for the impairment provisions, we think most SMEs probably won't be affected, but we'd welcome feedback on that point. And then we've simplified the current requirements for issued financial guarantee contract. We think that for a user will, you know, without the fallback, they'll know exactly where the requirements are coming from. And we do believe on those more complex financial assets, there would be better information on impairment losses. But as I said, we are seeking views. So you'll see in the request for information, we're asking about the expected credit loss model and whether that is the right balance between complexity and improving the requirements. Okay, I will move on to the consolidation package. So this is the IFRS 10 and IFRS 11, and as Jing Chao said, it was considered in the first review. At that stage, the standards were quite new, and the board decided not to implement them. But in this review, one of the questions that we'd asked in the request for information was about how far should alignment go, and it was, should it just be concepts? Should it be concepts and key definitions? Should it be concepts, key definitions, and requirements? And generally, we got support around it should be concepts and key definitions. And so, as control is one of the key definitions in IFRS standards, it seemed that we did have support to align with the definition of control, which was consistent with the discussion that the board had put in the request for information around aligning with IFRS 10. And currently the standard has two bases for consolidation, one being based upon the old SIC 12 for special purpose entities and then power for other entities. So we do think that by bringing in the definition of control, we're responding to that feedback that we had to align with key definitions, and we're responding to actually this is a single basis for consolidation. At the same time, we've been undertaking the second comprehensive review. The board has been undertaking the post-implementation review of 10, 11 and 12. And whilst there was some feedback, you know, IFRS 10 can sometimes be quite complex when you've got complex structures, there was also feedback that actually the single basis is pretty robust and works well. So I think it seemed right to be proposing to move to that single basis. But at the same time, the board is going to retain that rebuttable presumption that it has, that if you own over 50% of an entity, you do control it. So there'll be that rebuttable presumption will remain. And then it's a consequence of aligning with business combinations. We've had to add some requirements for partial disposals. Then in terms of IFRS 11, IFRS 11 was a little bit more complex. Having aligned the definition of control, it felt like we should align the definition of joint control. And in the RFI, the board discussed that that seemed the right way to go because these two projects went hand in hand. However, the classification of joint arrangements in the IFRS for SMEs is based on the old standard, IS 31, which is slightly based more on the legal forms of arrangements. And in the RFI, the board proposed to update the definition of joint control, so you would know when you had a joint arrangement, but not to change the classifications. And overall, there seemed to be support. So the proposals in the exposure draft are consistent with what we put out in the request for information. And there is There is actually one further proposal in IFRS 11, which is about adding requirements for when an entity participates but doesn't have joint control, which was necessary. Otherwise, we needed to backfill a gap. Otherwise, an entity wouldn't account for those assets that it has the rights to. So in terms of the effect on SMEs, we think the single basis of control should help SMEs. We don't think they necessarily have the complex structures that require the use of significant judgment that entities that apply IFRS 10 have, so we don't envisage there being such a significant problem there. And we've updated the definition of joint control as discussed, and we think that should lead users to have a lot more comparability in those financial statements. Some of the things the board didn't do, it's obviously not updating for the classification of joint arrangements that are in IFRS 11, and it's not proposing to bring in the fair value for requirements for investment entities. There was some discussion around this, but overall the board felt that it didn't need to bring those requirements in. So again, we're not asking people's views in the exposure draft on, do you think we should do this? We're asking, do you like the proposals? Did the proposals strike the right balance? And what are your views about the use of the undue cost or effort exemption? So quickly I will move to fair value measurement. We're not changing when fair value measurement is applied. The standard already requires fair value measurement. There is no change to that. What we're doing is just bringing all the guidance together in section 12. I have to say we had a lot of discussions about how to incorporate and where this section should go. In the RFI, we thought about putting it in section 2. Generally, people didn't like that idea, so we've combined sections, the old section 11 and 12, created a new section 11, and then added in a new section 12. So you'll see this is one of the sections that isn't marked up. We've updated the definition of fair value because it's one of those key definitions that we had the feedback on, that people wanted aligned. And we've added a bit more guidance to help people. There's a lot of cross-referencing that's changed in the standard as a consequence of this. So previously it said, in a number of places it said, go and look in these paragraphs in section 11. Now it says, go and look in these paragraphs in section 12. So a lot of consequential editorials required by introducing this new section. And we have added a few disclosures around fair value. But as I said, not changed where we are actually requiring the use of fair value. So, as I said, that's the effect on users. We don't see it as being a change in when you're using fair value, but to give you clearer guidance on how. And we think that some of the disclosures should help users of financial statements. So again, our question is exactly the same as section 2. Here's a new section. Have we got it about right? That's the feedback we're looking for in this, on this section. So with that, I'm going to hand over to Easton, who's been the master of revenue.
Thank you, Michelle. No pressure. So yeah, just a bit of maybe background to where we are at the moment. So we've got revenue requirements in section 23 of the IFRS for SME standard, and they're currently based on IAS 11 and IAS 18. So the proposal that we're putting forward is to revise section 23 for IFRS 15 and introducing the new model for revenue recognition into that section. So move to focus on transfer of control of the asset rather than risks and rewards. That proposal reflects feedback that we got from the RFI, but also from our advisory group, where there was general agreement around the proposal to align. However, they made very strong and very specific suggestions to introduce simplifications. So the cost of applying this new model would be easy and manageable for SMEs to apply. Basically, we didn't do a copy and paste job because we knew that would be far too much for SMEs to burden. So in terms of those simplifications that we've introduced, So the simplifications really focus on key areas of the standard where judgment is involved. And they really focus on steps 2 and step 5 of the model. And we see those as being one of the more fundamental steps of the model that entities need to get right. Therefore, we've focused on where we can offer simplifications to help them make the judgment associated with that. We haven't just restricted the simplifications, though, just to those 2 steps. We've also offered simplifications in other areas, most notably in relation to variable consideration, where we've changed and simplified some of the language. Time value of money, where we've directed entities to the existing requirements that are put in the IFRS for SMEs accounting standard in section 11, and also in around costs to obtain a contract, where we've introduced an undue cost or effort exemption in relation to the recognition of those costs as an asset. We've also simplified some of the language in the standard and also the structure. So with the structure, when you see the new revised section 23, what you'll see is it's been structured around the 5-step model, which is a different structure to the structure that's used in IFRS 15. Another change that we've made to make the standard easier for entities to apply, specifically on transition, is offering an option for entities to apply the revised section 23 prospectively. So entities will be able to apply those requirements to contracts that begin after the date of initial application, which means entities don't need to change their current accounting policy for contracts that are in progress at the point they transition to the new standard. That reflects feedback from the RFI, but also our advisory group, where we were told to help entities minimise their costs on transition. So again, that proposal, although it is optional, we hope that achieves that effect. So moving on to the likely effects of the changes to the revised section 23. Again, what I would say here is they are very similar to the intended benefits of IFRS 15. So for SMEs and those preparing SMEs accounts, we believe there'll be benefits in the more robust and logical framework that the new section offers, and also it's more comprehensive and it covers more revenue topics, so entities will not need to look elsewhere to get requirements to cover those areas which were currently left unaddressed in the current section 23. However, as with IFRS 15, we do see that for some entities there may be limited changes with applying the new revised section 23, but however, for others there will be more significant changes depending on the types of contracts those entities engage in, but also the type of industry that they operate in. So for example, SMEs that have licensing agreements or have longer term contracts, we would expect to see significant changes to the timing and also amount of revenue that they're recognising in their accounts. For users, we believe that there'll be greater consistency and also comparability in the information that they have on revenue in a SME's accounts, and that's both comparability with other SMEs applying the IFRS for SMEs accounting standards, but also other entities applying full IFRS. We also believe there'll be more informative disclosures given that we have enhanced requirements in this area. In terms of what we're seeking views on, we've got 2 questions on revenue in the invitation to comment. The first asks about the overall appropriateness of the revised section 23. So basically, do you think it will work? And we've honed down on those simplifications that we've offered entities, and we're looking for views on what you think of those simplifications specifically. Do you think in some areas we've simplified too much, or in other areas, on the flip side, simplified not enough? And then the second question specifically asks about those simplifications on the requirements for identifying distinct goods or services. So we spotlight on that section because it is a fundamental step of the 5-step model in IFRS 15, and we want to ensure those simplifications we've made, one, help make that section easier for SMEs to apply, but also at the same time gives them enough to apply it appropriately. So yeah, that's 2 questions on revenue in the ITC. And again, when you open up the ED, you will see, as Michelle said, it's a revised section, so we have offered that text in full. And again, maybe different to some of the other changes that Michelle has mentioned, we do expect this change to affect all entities applying the IFRS for SMEs standard, generally because most entities recognise revenue. Yeah, so just 3 topics that we wanted to run through that we're asking questions about in the invitation to comment. First is paragraph 28.19. So that requirement permits entities to use simplifications when measuring the defined benefit obligation in respect to current employees if it can't use the projected unit credit method without undue cost or effort. So it's an undue cost or effort exemption that exists within the measurement of that obligation. That topic was picked up in respect of feedback that we got, which indicated diversity in how entities were interpreting and also applying that simplification. So therefore, the proposal that's been taken to the board was to either retain that simplification and clarify it, or to remove it. And what's been proposed in the ED is the deletion of that paragraph. So therefore, SMEs will be required to measure these types of obligations using the projected unit credit method, and no undue cost or effort exemption will exist. And that also mirrors feedback that we did get on this simplification, that although it exists and might be unclear, it actually isn't commonly used amongst SMEs, given that the fact that when they do have these types of obligations, often they'll engage specialist valuers to help them value the obligation, and they'll use the projected unit credit method, or also SMEs generally don't have these types of employee benefits, therefore have no obligation to measure in their accounts. So the question in the invitation to comment is, do you agree with our proposal to remove? If you do not, do you agree with the clarifications that we are put in the ITC if we were to retain it? So that's paragraph 28.19. Next is IFRS 16. So IFRS 16 was in scope of the standard of this review, and the RFI did ask for feedback on it. That feedback was mixed, and we got told to make a more thorough assessment of the costs and benefits of introducing and bringing in IFRS 16 for SMEs, and also to obtain more experience from those who've applied IFRS 16. And also respondents gave us a few suggestions of how alternatives to alignment. So that was increasing the scope of the current financing leasing requirements in section 20 to all leases, and also enhancing the disclosures around operating leases. Those views were taken to this advisory group and also the board, and again, there's a bit of a theme here, the feedback was mixed. However, the board did 2 things. They agreed that leasing was relevant to SMEs, given we've got existing requirements in the IFRS for SMEs accounting standard, and they also rejected those alternatives that were suggested by respondents, given that they felt they didn't get close enough to the benefits that alignment with IFRS 16 could bring. Overall, the boards had a concern around the costs of these requirements might not outweigh the potential benefits of the information that bringing leases on balance sheet would bring. There was also questions around the timing of that, and as we heard about this morning, the board has a PIR of IFRS 16 on its work plan, and also the interpretation committee has projects related to the application of IFRS 16. So through those projects, we can get more information about the costs and benefits of the standard and relate that to how and whether to align IFRS 16 with the IFRS for SMEs accounting standards. So the invitation to comment asks 2 things. It asks, do you agree with where the board landed on this, to not align with IFRS 16 as part of this review, but to consider as part of a future review once they have information about more information about costs and benefits. And also, secondly, it asked for information about those costs and benefits of alignment. So here it's really asking for the benefits of alignment from the perspective of users, and also the costs of not having this information, also from the perspective of users, and also the costs of requiring leases to be brought on balance sheet for SMEs. So in summary for this topic, you'll see no change proposed in section 20 in the exposure draft. That discussion has been deferred by the board to a future review, and in the interim, they're going to look to get more information on costs and benefits through the other projects the board is undertaking, and also through the invitation to comment. And then very finally, we are looking at the treatment of development costs. So currently, the IFRS for SMEs accounting standards requires these costs to be expensed, and that differs from the existing requirements of IAS 38, where an entity can recognise an intangible asset if those costs meet specific criteria. That simplification has always existed for SMEs in the standard, and that's due to cost-benefit reasons. And the costs that the board saw at the time of developing the standard was that SMEs would lack the resources to make those assessments for all those development costs, and also there'd be limited benefit associated with bringing those assets onto a SME's balance sheet, given that the board received specific feedback from lenders that they often disregard those assets when making decisions about whether to extend credit. That was back then. This is now. The topic has been raised again, and you know, in respondents' view to that, they did give us evidence that there's increasing significance of intangible assets in SMEs operating in business models. Therefore, they believe SMEs should have scope to recognise these costs as assets, to sort of give a better representation of the importance of those assets to the way that they're generating revenue. Topic was discussed by the board, and what they've decided is to use this exposure draft as a way to get feedback on the potential to introduce a scope for entities to recognise these costs as assets. And what the board has set out in the invitation to comment is, if they were going to do that, their preferred option would be to introduce an accounting policy option to do so. And they did have a bit of discussion around whether they should introduce the undue cost or effort exemption, and as Michelle said, we have those in other areas of the standard, but they fell on the side of a simple accounting policy choice, as they felt that introducing that type of exemption would increase the judgment and complexity around what is already quite a judgmental and complex judgment to make around whether to recognise those costs as intangible assets using the criteria in IAS 38. So again, you will see no change in this section of the standard, but in the invitation to comment, you'll see a question specifically on the potential to introduce scope for entities to recognise these costs as assets through an accounting policy choice.
And I just remind you that the common period of exposure draft is 180 days. So the common period will end 7 March 2023. We are looking forward to your comments, particularly if you have any concerns, suggestions, particularly constructive advice to the board. Please submit your comment letter to us.